Hello everyone, John AG here. Welcome back to my channel, Aurex. If you haven't yet, subscribe to my channel. In this channel, you will find the real information, real market updates that everyone cannot tell you. So please subscribe to this channel and love you, all of my subscribers, for your support. And please watch this video till the very end because YouTube will not push my videos to more people, and the algorithms actively suppress the harsh financial truths we are about to uncover today. Right now, as we sit here on May 21st, 2026, the world is on fire. The geopolitical landscape has completely fractured. We are watching unprecedented military strikes in the Middle East. The Strait of Hormuz, the vital, irreplaceable maritime artery that handles roughly 20% of the entire globe's oil supply, has faced blockades that have brought global logistics to their knees. Supply chains are choking, completely paralyzed by fear and soaring insurance premiums. Inflation in the United States, which the government promised was under control just a year ago, has stubbornly reared its ugly head, back up to 3.8%. Fear is not just a passing emotion right now. Fear is the dominant driving currency in the global markets. If you have read any financial textbook, if you have listened to any traditional financial advisor, or if you have simply studied the last 5,000 years of human history, you know the golden rule. It is etched into the bedrock of wealth preservation. When the world burns, gold flies. Gold is supposed to be the ultimate safe haven. It is the indestructible asset. It is the sovereign shield against the apocalypse. And for a brief, fleeting moment earlier this year, it acted exactly as the textbooks promised. In January 2026, gold skyrocketed. It broke all previous historical boundaries, tearing past $5,000 and peaking at a staggering euphoric high of $5,595 per ounce. Euphoria gripped the retail market. Analysts on every major financial network were calling for $7,000, $10,000, and even higher. People were pulling cash out of their retirement accounts, taking out second mortgages, and liquidating their stock portfolios to buy physical bars, absolutely convinced that the fiat currency system was on the verge of total collapse. But I want you to pay very close attention to what I am about to say, because this is where the mainstream narrative completely falls apart. Instead of continuing its historic march upward as the war intensified, gold collapsed. It suffered its biggest, most violent weekly drop in over 15 years. It fell from that euphoric peak of nearly $5,600 down to the $4,400 range, a brutal, wealth-evaporating plunge of nearly 20%. How is this possible? How can the ultimate safe haven asset crash precisely when the world needs a safe haven the most? Why is gold crashing during a brutal, escalating war? Today, we are going to strip away the noise. We are going to look at the cold, hard, unforgiving mechanics of the global financial system. I am going to explain the hidden forces that are actively crushing your gold portfolio, and I am going to reveal who is actually buying the very gold you are selling in a panic. Because the truth is, the market isn't broken. It is operating exactly as it was designed to. You are just looking at the wrong variables. Before we dive into the macroeconomics, we must talk about the human element. Finance is not just numbers blinking green and red on a screen. Finance is human energy, crystallized into capital. Over the last few months, I have received hundreds of emails from you, my viewers. The stories are heartbreaking. I heard from a father named David in Ohio. Back in February, David liquidated a massive portion of his children's college fund. He bought gold at the absolute top because he was terrified of the inflation numbers and the news of missiles flying. I heard from a retiree named Sarah in London who watched her pension's purchasing power melt away month after month. She moved her entire life savings into gold ETFs to protect herself. They did exactly what the financial media told them to do. They sought safety. They acted responsibly. And for doing the responsible thing, they were violently punished by the market. They watched 20% of their hard-earned wealth vanish into thin air, right as the cost of groceries, gas, and electricity continued to skyrocket. There is a unique, sickening feeling when the very asset you bought to protect you becomes the asset that bleeds you dry. It is a psychological torture that makes you question your own sanity. You look at the news and you see cities burning. You look at your portfolio and you see gold crashing. The cognitive dissonance is deafening. But I want you to take a deep breath. You are not crazy. The foundational logic of buying gold during a crisis is sound. What the media intentionally withheld from you, however, is that in our modern, hyper-financialized, globally interconnected, debt-based economy, geopolitics does not dictate asset prices. Liquidity and interest rates dictate asset prices. When war broke out, two massive macroeconomic wrecking balls swung directly into the gold market: the United States Federal Reserve and the unstoppable force of the king dollar. To understand why gold fell, we have to step into the mathematical reality of holding assets in an environment of aggressively high interest rates. Let us look at what happened in early May 2026. The United States Senate confirmed Kevin Warsh as the new chair of the Federal Reserve. Inflation is running at 3.8%, driven heavily by the energy shock from the Middle East. Warsh made his position abundantly, painfully clear to Wall Street. The Fed is not pivoting. They are not coming to the rescue. Inflation discipline is absolutely non-negotiable. Interest rates are staying high, and they will stay high for as long as it takes to break the back of this inflationary wave. This creates a lethal, suffocating environment for gold, and it all comes down to a fundamental, inescapable concept in finance known as opportunity cost. When institutional investors value any traditional financial asset, like a stock or a corporate bond, they look at its future cash flows and discount them back to the present. The formal foundation of this valuation is the present value equation. PV equals FV over 1 plus R to the power of N. In this formula, PV is the present value, FV is the future value, R is the discount rate or interest rate, and N is the number of periods. I want you to look closely at that denominator. As the interest rate R increases, the bottom of that equation grows larger and larger, which mathematically crushes the present value of any future cash flows. But here is the critical, fatal problem for gold in this environment. Gold has no cash flows. It is a sterile asset. It does not pay a quarterly dividend. It does not yield monthly interest. It just sits in a vault, costing you money to store and insure. Its entire value proposition relies on capital appreciation and the preservation of purchasing power. Therefore, the only mathematical metric that truly matters for the price of gold is the real interest rate. The real interest rate is simply the nominal rate minus expected inflation. R real equals I nominal minus pi expected. In previous historical crises, think back to the great financial crisis of 2008 or the pandemic panic of 2020, when fear gripped the market, central banks panicked right alongside the public. They slashed interest rates to absolute zero. They fired up the monetary printing presses and flooded the zone with trillions of dollars of synthetic liquidity. In that environment, the real interest rate went deeply negative. When inflation is soaring and your bank pays you 0% interest, holding cash is a guaranteed way to lose your wealth. In that specific scenario, holding a zero-yielding asset like gold is a massive mathematical upgrade. That is when gold moons. That is what retail investors were expecting to happen in 2026. But here is the hook that caught everyone off guard. 2026 is entirely different. The Federal Reserve did not cut rates when the war escalated. They held them high, terrified of a 1970s-style inflationary spiral. United States Treasury yields remained pinned near multi-year highs. So put yourself in the bespoke Italian leather shoes of a billionaire hedge fund manager in New York. The world is a terrifying place. You want safety for your billions. You have two choices. You can either buy gold, which pays you precisely 0% and costs you millions in storage and insurance fees, or you can buy a short-term US government bond. This bond is universally considered the safest, most liquid asset on planet Earth, and it pays you a guaranteed risk-free yield of 5%. The math is brutal, cold, and completely unforgiving. When an institution can get a 5% return on cash, holding a dead, non-yielding rock becomes financially irresponsible, if not fiduciary malpractice. Capital, which is purely rational and completely devoid of human emotion, violently rotated out of the gold market and flooded into high-yielding government debt. But the assault on gold did not stop there. The second macroeconomic wrecking ball is the very currency in which gold is priced, the United States dollar. We exist in a dollar hegemonic world. Gold is universally priced, traded, and settled in USD. Therefore, gold and the dollar operate on a strict mechanical seesaw. When the dollar weakens, it takes more dollars to buy the same exact ounce of gold, so the price of gold goes up. But when the dollar strengthens, it takes fewer dollars to buy that ounce, and the price of gold crashes. When the conflict erupted in the Middle East in early 2026, global panic ensued. But in moments of true, systemic, existential global terror, the world does not run to gold first. The world runs to the ultimate global liquidity mechanism, the US dollar. European pension funds, Asian manufacturing conglomerates, emerging market governments, they all aggressively sold their local currencies and bought dollars. They desperately needed dollars to service their dollar-denominated corporate and sovereign debts. They needed dollars because the US economy, despite its massive internal political flaws and staggering debt load, was still perceived as geographically and economically isolated from the immediate blast radius of the Middle Eastern War. The DXY, the index that measures the US dollar against a basket of major foreign currencies, surged to terrifying heights. The dollar became a wrecking ball, destroying everything in its path. And this strong dollar was absolutely catastrophic for the global gold market. Let me explain exactly why this happens, because this is the secret dynamic Wall Street does not want you to understand. The biggest, most consistent buyers of physical gold in the world are not Wall Street bankers sitting in Manhattan. They are everyday people, families, and local merchants in India, China, Turkey, and the Middle East. When the US dollar strengthens drastically, local currencies like the Indian rupee or the Chinese yuan weaken dramatically against it. So, while you, sitting in America, were looking at your screen watching the gold price drop in dollars and thinking it was getting cheaper, a family in Mumbai looking to buy gold for the upcoming wedding season saw the price of gold in rupees remain painfully, prohibitively expensive. The strong dollar effectively killed the physical retail demand from the Eastern Hemisphere. They were completely priced out of the market by the brutal mathematics of the foreign exchange rate. Without that massive, foundational, physical retail buying pressure from the East to act as a floor, the bottom simply fell out from under the paper gold market in the West. You might be asking yourself right now, if the world is terrified and institutional money isn't buying gold, where exactly is the speculative, crisis hedge money going? The answer is black, sticky, and highly flammable: oil. When the Strait of Hormuz effectively closed down, choking off a fifth of the world's daily oil supply, the financial markets woke up to a harsh, physical reality. Gold is a psychological hedge against inflation and systemic collapse, but oil? Oil is the literal, physical blood of the global economy. Without it, trucks don't move, food doesn't reach the supermarkets, and the modern world grinds to a halt in less than a week. Institutional investors realized immediately that if they wanted to hedge their portfolios against this specific geopolitical war, gold was the wrong asset. Oil was the direct, immediate casualty of the conflict. So, hundreds of billions of dollars in institutional money flooded out of gold and into crude oil futures. Oil surged past $100, violently reaching towards $120 a barrel. Here is the sinister, highly counterintuitive feedback loop that completely blindsided retail gold investors. I need you to follow this chain of events closely. First, the geopolitical war shock causes global oil supplies to drop. Second, this supply shock causes oil prices to spike over $100 per barrel. Third, these exorbitant energy costs bleed into every single layer of the global supply chain, pushing consumer inflation up, which is exactly why we saw that 3.8% CPI print in April. Fourth, to fight this oil-driven inflation, Chairman Warsh and the Federal Reserve are forced to keep interest rates extremely high. Fifth, these high interest rates act as a magnet, attracting global capital and supercharging the strength of the US dollar. And finally, a super strong dollar combined with high interest rates completely destroys the investment appeal of non-yielding gold. Do you see the trap? The very war that everyday investors thought would send gold to the moon actually created the exact macroeconomic conditions: high oil, high rates, and a strong dollar that guaranteed gold's destruction. The war killed gold indirectly. Now we must address the sheer violence of the crash itself. Why did gold drop 20% so incredibly fast? Why wasn't it a slow, manageable bleed? The answer to this lies in the most dangerous word in finance: leverage. We have to talk about the brutal, merciless reality of the margin call. Back in January 2026, when gold violently crossed the $5,000 threshold, FOMO, the fear of missing out, completely took over the retail market. Retail traders, heavily influenced by sensationalist social media influencers and panic-driven news cycles, didn't just buy physical gold coins, they bought paper gold. They bought heavily leveraged, exchange-traded funds. They traded contracts for difference and highly volatile futures contracts. And they did all of this using massive amounts of borrowed money. When you buy an asset with 10 times leverage, a 10% move in your favor doubles your money. You feel like a genius. But a 10% move against you wipes out your entire account. As the macroeconomic factors we just discussed began pushing the price of gold down slightly from its euphoric peak, it triggered a chain reaction of absolute devastation. Prime brokers looked at these highly leveraged retail and hedge fund accounts and saw they were deeply underwater. The phone rang in the middle of the night. The broker on the other end of the line didn't negotiate. They simply stated, "You need to deposit more cash right now to cover your losses, or we are liquidating your entire position." This is the dreaded margin call. The vast majority of these retail traders did not have the cash to meet the call, so the brokers' algorithms took over and forcefully sold their gold at the market price. Millions upon millions of ounces of paper gold were dumped onto the open market simultaneously. This sudden, massive wave of forced selling pushed the price down even further, which triggered the next level of margin calls, which triggered more forced selling. It was a mechanical doom loop, a pure, unadulterated liquidity wipeout. In a true liquidity crunch, correlation goes to 1. You do not sell what you want to sell. You sell what you can sell. Traders who were bleeding money in the crashing equity markets had to sell their winning gold positions just to raise enough cash to survive another day. The paper gold market did not crash because the physical metal lost its intrinsic historical value. It crashed because over-leveraged gamblers ran out of money and the algorithms liquidated them without mercy. This brings us to the most intellectually gripping and perhaps the most terrifying part of this entire story. This is the piece of the puzzle that changes everything. While the retail investor in America was getting wiped out by margin calls, and while the hedge funds in London were dumping their gold ETFs to chase a 5% yield in US Treasuries, someone else was quietly, aggressively, and relentlessly buying up the physical metal at these discounted prices. Who is absorbing all of this gold? The sovereign central banks of the global south. We are currently witnessing the greatest, most profound divergence in the history of the gold market. The market has completely fractured into two distinct realities. On one side, you have the paper gold market of the West. This market is driven by speculators, interest rate expectations, algorithmic trading, and leverage. On the other side, you have the physical gold market of the East. This market is driven by sovereign nations fighting for their geopolitical and economic survival. To understand this, we have to look back to 2022, when Western nations jointly agreed to freeze hundreds of billions of dollars of Russian foreign exchange reserves following the invasion of Ukraine. A cold, undeniable shiver ran down the spine of every developing nation on Earth. Countries within the BRICS alliance, China, India, Brazil, Saudi Arabia, South Africa, realized something absolutely terrifying. They realized that if their national savings are held in US Treasury bonds, those savings are not truly theirs. They are essentially digital IOUs that policymakers in Washington, D.C. can turn off with a single keystroke if a nation steps out of line politically. For the global south, gold is no longer just a quaint hedge against inflation. It has been transformed into a geopolitical shield. Despite the terrifying crash in the paper price you see on your screens, look at the underlying physical data. In the first quarter of 2026, central banks bought over 244 tons of gold. This is a staggering historical amount of metal. And they are not day trading it. They are not buying paper ETFs. They are buying heavy, unencumbered physical bars. They are loading them onto cargo airplanes, flying them across the world, and storing them deep within sovereign vaults where no foreign government, no matter how powerful, can ever freeze them, sanction them, or seize them. While you are losing sleep over a 20% drop in your paper portfolio, the People's Bank of China and the Reserve Bank of India are silently thanking the Western speculators for driving the price down. They are viewing this crash not as a financial disaster, but as a generational, once-in-a-lifetime accumulation zone. They are using this massive dip to systematically de-dollarize their economies. These sovereign entities are playing a game of chess while the West plays checkers. They know that the current United States monetary policy, running massive multi-trillion-dollar fiscal deficits while simultaneously keeping interest rates at 5%, is mathematically impossible to sustain in the long run. The interest expense on the U.S. national debt is consuming the government from the inside out. The Eastern powers know that eventually, inevitably, the United States will have to cut rates. They will have to turn the printing presses back on to monetize and service their exploding $39 trillion national debt. And when that day inevitably comes, the perceived strength of the dollar will crack. When the dollar cracks, physical gold will be the only neutral, uncensorable, Tier 1 monetary asset left standing on the global stage. So where does this leave you? Where does this leave the average investor who is just trying to navigate a world that feels like it is violently spinning off its axis? First, you must separate your human emotion from the cold mechanics of the market. You must deeply understand that in the short term, the price of gold is just a financial instrument heavily manipulated by interest rates, the strength of the dollar, and the brutal margin calls of over-leveraged traders. If you are trading paper gold on leverage right now, you are effectively playing Russian roulette in a casino where the Federal Reserve controls all the odds. It is a game designed to strip you of your wealth. But if you zoom out, if you look past the deafening noise of the 2026 crash, past the immediate visceral terror of the Middle East conflict, and past the fear-mongering of the financial press, the structural long-term macroeconomic case for physical gold has never been stronger in human history. The world order is fracturing in real time. The era of unquestioned, unchallenged dollar supremacy is being actively dismantled by half the globe. The central banks are showing you their hand. They are telling you exactly what the future of money looks like, and they are backing up their thesis with thousands of tons of physical accumulation. Gold is crashing today because the temporary mathematical conditions of the current moment demand it. The opportunity cost is too high, the dollar is too strong, and the leverage in the system had to be purged. But the financial history of the next decade is not being written by the paper speculators getting liquidated in New York and London. It is being written by the sovereign nations quietly hoarding the physical metal at these artificially suppressed prices. Do not let the short-term algorithmic volatility blind you to the long-term, undeniable geopolitical reality. Be smart. Manage your risk with absolute discipline. Stay far away from the toxic allure of leverage. And above all, deeply understand the true, fundamental nature of what you are holding. Thank you for staying with me until the very end of this video. If this deep dive opened your eyes, if it gave you the vital perspective that the mainstream media is actively failing to provide, please hit that like button right now. Share this video with someone, a friend, a family member, a colleague who is panicking about their portfolio today. Let me know in the comments below. Are you using this paper crash to accumulate physical metal like the central banks? Or are you sitting on the sidelines in cash, waiting for the dust to settle? Remember, our goal here is not simply to survive the chaos of this financial system, but to deeply understand it, master its mechanics, and position ourselves accordingly for the future that is coming. This is John AG. This is Aurex. Stay safe out there, stay informed, and I will see you in the next video.